The week ahead, I want to review some major themes we've been talking about for several months before we get into specifics for trading on Monday. One major theme that we have talked about for quite a period of time are the odds that we are looking at stagflation. Stagflation occurs when you have stubborn inflation and softening employment. And there's now more of an agreement that stagflation does exist. The next thing we've been talking about is that this market seems to have been in the domain of very short-term traders. And so much of what makes that evident is the mechanical nature of the way the market has traded. When you look at the trend lines, almost exactly to the trend lines. Even the break that came this last week, if you take a look at the Thursday high, you know, it's right on the trend line. The next major theme that we've been talking about is that long-term investors, that really large money that makes their money from holding securities for extended periods of time, is not inclined to really panic like the rest of us do until the market's down, you know, 8 to 10%. Well, one more time, we are back to that level. This is the level, the reason that this is more significant where we are right now than it has been for some time, because they are going to be feeling the same pressures that you and I as short-term traders feel on a daily basis. These investors pride themselves on, you know, being cooler than we are and not panicking. But I can assure you from my experience, they are starting to get the calls from clients. And when they start to get the calls from clients, they start to feel the same pressures we do. They just feel it less often, but when they do succumb, it can be fairly dramatic. And that's why you have to pay attention to where we currently are. The last thing that I want to bring up before we go into more specifics to prepare for Monday is, as short-term traders, the importance of inventory correction. If you look at the previous low on there, looking right here at this low, you had a huge short covering rally and a huge gap that took the market back up to, you know, a level that I had kind of identified as a resistance level. Those short covering rallies can be very misleading. When inventory gets too short, it adds short-term strength to the market. How do you cover a short? You have to buy, and when there's potential buying, that strengthens the market. Traditional momentum players get misled by the short covering rally. And I think that's what happened here. And as you can see, the market, you know, even after it made that huge gap, it hung up there for, you know, another day, and then the break started again. The reason I'm bringing this up is because one more time, as we're at this very crucial level coming into next week, inventory is exceptionally short once again. That doesn't have to mean that we're going to have a short covering rally, but it is something you need to be prepared for. And the final thing is, remember, short-term traders must understand that markets are tremendously random. They may not be as random on a longer term basis or an intermediate term basis, but they are certainly random on a very short term basis. Now, that randomness can be from a news event. It can be from something that triggers a short covering rally. It can be positive news. It can be negative news. But just be aware of that. All right. So with that in mind, let's take a look at the final graphic. And incidentally, I use the SPY to look at the bigger picture, but I'm using the ES profile to look at the short-term preparation for Monday. One of the reasons, if you will notice in front of you, after the close on Friday, there was another breakdown in the market. So the key things I'm looking at as we come into next week are, I'm treating that late break on Friday as a spike. The earlier low I'm using as the spike base or the spike high. Now, the spike trading guidelines to review are as follows. The resistance, the base of the spike would be resistance if the market rallies. If the market is accepted within the spike, or we open within the spike, that shows acceptance of that break late in the day, and that is potentially a negative event. The most positive event would be to open above the spike. Now, keep perspective. If we open above the spike or we trade below the spike and come back in to Friday's range, the key reference point I have there is the Friday afternoon rally high. Trading is about change, and we're always trying to, make some assessment. Is there major change underway? If there was major change to the upside, the market would find its way back above the afternoon rally high. If there is good continuation to the downside, we will open within or below the spike and remain in or below the spike. And like I say, the market is random. Inventory is very short, but the news is also very heavy. I don't have any more insights than you do. I just use the things I've talked about in order to guide me as we prepare for Monday. Have a great week and great trading.